Today I want to talk about our outlook on Chevron stock for Q2 2024. My name is Stephen Chambers and I'm a wealth manager at Willis Johnson & Associates. The last 12 months, Chevron's up about 4%. Most recently, it's on pace to have its largest decline since October of 2023. So right now could actually be a good entry point. Looking over the last 4 years, it's been a crazy ride. Big picture, guys, 2021 price of crude was up 60%, kind of rebounding from COVID, and so Chevron was up 45%. And in 2022, there was nowhere to hide except for cash and energy stocks, and as a result, Chevron was up 58%, right? And so the big thing here is, as an investor, is not to anchor your expectations on 2021 and 2022, right? Those were more by and large anomaly years. And as what we're seeing going forward is the market is pricing in more average returns. And as a reminder, guys, the price of Chevron is highly, highly correlated with the price of crude. Going back 5 years, it's almost a perfect correlation. Right now, Chevron's trading at 12 times its earnings. And so are other energy stocks compared to the S&P of 20 times its earnings. So there is a discount with the energy market, which assumes that Chevron will grow its earnings by 18% over the next 12 months. Compare that to its 3-year average of 12. So the question is, can Chevron achieve the earnings growth the market is pricing in? Looking at its peers, Exxon, ConocoPhillips, EOG, the 2-year revenue forecast for Chevron is actually 0.5%. So it's the lowest in its peers, but its earnings projections are at 7.4, which is its highest in its peer group. So there could be some value opportunity within its peers, but who knows? And ultimately, this should help your SIP payouts. This is where things get kind of interesting. If you look at energy compared to the other sectors in the S&P, energy actually has the lowest revenue growth rate through 2026 at negative 0.3%. Compare that to, say, technology at 5.4, industrials at 8.6, and its earnings growth rate through 2026 isn't all that great either, at 8.2% versus, say, communication services at 13, the S&P at 13%, and technology, of course, at around 13% as well. So not the best fundamentals. So what that boils down to from an valuation perspective, still looking at the energy sector compared to other sectors, is they're pricing 12 times the earnings for energy stocks, which is the lowest out of every other sector. So by and large, guys, what the markets are doing is they're saying, okay, energy, you've had a great run in 2021, 2022, but we think more average growth going forward, and so we're going to price you at 12 times versus S&P's at 20, technology's at 28. So we could see the market is saying that maybe the good days that we've seen are kind of done. The 3-year return, this is pretty fascinating. The last 3 years, energy has outperformed every other sector, which, again, given the recent run-up in 2021 and 2022, maybe not so surprising. It's up 98% versus technology's up 70, for example. But here's where things get interesting, and I like to say is kind of two tales over the last decade. Energy has been the worst performing sector in the S&P, up 46%, versus technology is up 650, the S&P is up 236, etc. Is the market correct in pricing in some of these fundamentals poorly? Is energy a value play? Is it a momentum play, or have they run its course? Right? I don't know. But what I do know about energy investing is if you want to invest in energy, there's a price that you have to pay, and that price is called volatility. So this is a kind of a periodic table of what we just talked about, but what I wanted to highlight is there at the top. Over the last 10 years, you see at the bottom, energy's at 3.5. It's the second worst asset class, but it's the most volatile at 53%. Versus, say, the technology at 19, the S&P at 14. So for those watching this and are invested in energy stocks, you can attest that there is rewards to investing in energy, but it comes as a price, and that price is volatility. And the question we really want to ask ourselves is, how much volatility can my portfolio handle? And of course, that depends on your time horizon. Chevron's volatility metric, standard deviation, is 28%. This means over the last 3 years, there's a 67% chance that Chevron stock was up, it was plus or minus 28%, right? So for example, let's say you have a $2 million portfolio, it's invested 100% in Chevron. Your portfolio over the last 3 years could have been up $2.6 million or down $1.4 million. A lot of volatility, that's a huge fluctuation. The question is, are you comfortable with that? Do you need to take that amount of risk, right? Let's look at your LTIPs for a second here. Your non-qualified stock options, most of the grants, except for 2023, are in the money. They're profitable, right? The one advantage that non-qualified stock options have over your RSUs or your PSUs is their leverage. Now, options have leverage, and meaning a smaller upfront investment, the exercise price, can control a large number of shares compared to just buying the stock outright. So this leverage allows for potentially magnified profits, right? If the stock moves up. It can also happen in the opposite direction. Now, this is the advantage that non-qualified options have over the RSUs, PSUs. So why leverage is important? Leverage gives us an idea. It's a useful tool in deciding which options to exercise. And as a rule of thumb, the higher the leverage, the higher the potential return. The lower the leverage, the lower the potential return. So just looking at some of the grants, 2021, 54% leverage. It's low compared to the other ones. If we wanted to trim some of the exposure, the 2021 grant could make sense. 2024, 2018, 2022 have higher leverage. Let's hold on to those to allow for the power of leverage to work in our favor. Don't forget to subscribe to our YouTube channel for more educational content. Thank you for watching.